the backdrop, global financial crisis of 2008 was a watershed event. Academicians may call that structural break from what the finance used to be and what finance has come to be subsequently. Why I call that? Central banks, they thought that the solution of a problem lies in quantitative easing. It all began with building of confidence because there was a complete crisis of confidence in 2008, and that is where it all began, Fed intervention, which led to, or which was the beginning of something called a sovereign debt crisis. That means few countries in Europe, they were unable to pay off their obligations. The government was not able to pay off their liabilities. So, sovereign debt crisis, sovereign crisis. Ending quantitative easing. They tried from December 16 to December 18, from 0.5 to 2.5, they raised the interest rates. And I remember what we used to call is that you are riding a tiger. When the quantitative easing was like riding a tiger. You don't decide that can you get out? Can you get off the tiger? Probably it was very difficult. The same thing happened. They had to again reduce the rates, and come COVID, the rates came back to 0.25 again. Okay. I know the market participants, analysts, and fund managers, they were anticipating that. And then we came what is called QT, quantitative tightening. As inflation reared its head, the central banks across the globe, or Fed in particular, started tightening. And today we are standing at Fed funds rate of 5.5%. From almost about, from 2.25% to 5.5%. That's where you are. Now look at this one, the first point. 2020 Fed balance sheet size was $4.3 trillion. If you ever look at the balance sheet of a central bank or a bank, central bank particularly, their liabilities are the currency they have put in circulation. From $800 billion in 2000, prior to 2008 crisis, it has today gone up to almost about 7.6 today. At the peak was $9 trillion. And mind you, these are numbers, you must stomach those numbers, $9 trillion. Our total GDP, even at, even in nominal terms, will not be more than less than $4 trillion in nominal terms. Real terms, it will be what? Less than 3.2, 3.3, depending on approximately thereabouts. So $7.6 trillion of balance sheet of Fed as of now, after quantitative tightening from 9 to 7.6. Okay. And of course, we have now again, there is a discussion in USA about that Fed should be cutting rates because increasing rates have caused untold misery and going to create a further problem for the financial system. This is the background. Now let's look at I have just put down in a very simple terms what in my experience has been corporate finance companies. Technically, as organization, you read in your management, the managers are different from the owners, the promoters, because the companies are, different animal, and as they grow in size, it's very difficult for an individual or a family to manage. So this is given rise to what is, in finance, it's called agency conflict, agency problem, agency costs, whatever you would like to. I mean, costs are estimated to be the problem. Okay. Then openness, transparency, theory assumes all that. And let me tell you a framework of corporate finance. This is the framework. From a corporate finance point of view, see, managers are at the center of all corporate finance decisions. They decide. Okay. Now here are on one side is the lender. On the other side is here it is bondholders Stockholders. Stockholders are promoters and the minority shareholders. And you have on one side is financial markets where they draw their lifeblood from. And at one end is society. Now, every company is interacting, like you study capital structure. Either you're borrowing money, which is lenders, or you're asking for equity, your stockholders, besides the promoter money. And then you are interacting with the financial markets. Here are these. And all along these, the corporate finance assumes that managers are acting in the best interest of the business. Okay. And when we say corporate finance, the job of a corporate finance person or a CFO or whatever you would like to call that, whatever position is named, is basically to maximize the company's value. Okay. All actions. That's why there is decision making. So let's understand. In theory, it's all very fine. In reality, how does this all function? Companies were run even by people, those who are not corporate finance graduates or MBAs. Any business person knows that if I'm borrowing money and I'm putting for investment, my rate of return on the investment has to be higher than the money I'm borrowing. Dhirubhai Ambani was not a MBA. And so a whole lot of other people, they were not, So it's a very simple common sense idea that what you learn as a IRR, saying projects, internal rate of return, what it gives me, where you assess the cash flows, inflows and outflows, howsoever correctly or incorrectly. And then when you are looking at growing organically or inorganically, it basically boils down to the question, do you have the use for the money which earns you a high return on equity? That's one parameter you decide with respect to whether the investment I am making is going to give me a high ROE or not. Otherwise, I will not invest. Whether it's going by a organic growth or inorganic growth. Okay. Now, of course, acquisitions are, because if you want to, like particularly in case of IT and even in case of Fintech, we'll see that. That's one way that where if you want to grow faster, so instead of waiting for you to really make money and grow, you make acquisitions. Ultimately, in real life, the financing decisions are dependent on retaining the control of business. I do not want to compromise with respect to losing the control. Even today, I have seen, for example, a company which is held completely by a privately, family owned. When they are looking for equity, say for example, they want to sell to private equity, you go and talk to the family, saying here is the guy, you can value your business so much, and you need to just sell maybe 25% or 30%. They're not willing to do that because they think that control will go away. Whereas, while our suggestion is that there are companies which are being controlled even by 15-20% shareholding. You need to be in the driver's seat. So financing decisions are basically limited by that single objective, retaining the control of the company. Why? Because it gives me freedom to do what I want to do with the business. With somebody else coming in, I will be answerable, right? And they are dynamic in nature. Dynamic in the sense is like for a mature company, vis-a-vis a startup company, there will be different needs of finance. When you're saying if you're making money and you want to grow faster, so you need to probably retain a whole lot more than the company which doesn't really have enough, growth projects in hand. What I have seen that as we move from, to almost zero or close to zero interest rates globally, there was a, run for high cost debt was placed with the low cost debt. And another interesting development that happened was that if debt is cheaper and is also tax deductible, so virtually cost of debt is zero. So replace, because cost of equity is more, so you replace equity by debt, and this was in a sense de-equitization, and this happened, in a sizable way. I'll give you the data on that. And when tax rates are higher, it automatic choices that you go for the preference for debt goes up because the cost accordingly goes down. Okay. And one more point which has been observed very clearly is that insolvency and bankruptcy code, and this I've seen in a number of cases where one has been associated with, that promoters are fearful of losing control of the company. If it is in distress, yes, they need money, but at the same time, they do not want to go through the process of IBC. There were earlier lacuna in IBC wherein you could use the third party to get back into your own company. That seems to have been plugged by, you can't buy back your own company. Okay. So in that sense, that they were very fearful about, I should not lose control. In India, we have another, like I come from a business group. There was also a reliance on intra-group funding. Like, for example, one company is in need of funds. Another company within the group can supply funds at a lower rate or at the market rates. That is far more easier, because in case the company goes into distress, there is no chance of you're losing the control of the company. There's one other development: growth and financial stability. Now these are one can say that these are theoretical constructs of saying while you're looking at growth, and there's nothing called an optimal structure. It exists only on the in textbooks or on probably paper. Largely, most corporates, for example, within their budgeting plans, they look at is that they manage within the business abilities to generate money. They would be looking at raising of debt or equity depending on what projects on hand and what kind of growth projects they envisage in future. Okay. So there is nothing that we should be targeting at 1.2. Okay. They may have, the CFO may have something in their mind saying, I should not carry debt on my books more than maybe twice or three times my EBITDA, depending on the business you are in. So that's the practical aspect of it. So you can't really say I'll fix up at 1.2 and I won't borrow beyond that. So there may be short-term requirements because of business exigencies. You are suddenly, for example, inventory don't move. You don't get money paid by the vendors. Okay. What do? So your working capital finance raised, and suppose that becomes a short-term to medium term. So those are contingencies which you can't really avoid in business. Now this is what is just a CMI data which says that from a average debt to equity ratio, which was 1.2 to almost about, from 2000 it fell to about 0.885 or 0.9, close to that level. Okay. So some deleveraging happened, and I think this was prominent from this particular period, 2015-16. Direct correlation cannot be, you can't really attribute saying because of this reason. There may be multiple reasons, but one of the reasons could be that IBC. Now, in a bid to look at lower cost, the corporates had looked at an option which is called foreign currency convertible bonds. It was a very, very popular mechanism. Now, this is a quasi debt, which is basically convertible at a price which is determined at the beginning, 5 years from the date of issuance. And something very interesting happened, that while rates were low during when FCCB were issued, and rupee that time, if you remember, I don't know whether you've done a study of that, 2007-8, rupee had appreciated from almost about 46-47 rupees to almost about 38-39 rupees, almost 40 rupees. So that means because of large inflow of money which came from portfolio investment, so the rupee, demand for rupee went up and rupee appreciated as dollar and yen carry trade created a positive framework for rupee. So nobody anticipated at that time that rupee will depreciate. And came 2012, you had the double whammy. The markets went down and the rupee depreciated. So now you had to, the conversion, the investors were holding the option to convert their FCCB into equity. Now your equity is at the lower price than the original conversion price. So they will not convert. Now you're not in a position to pay back because rupee is depreciated. So your interest costs virtually are higher and you are in a tight fix.